minutes from the close of trading here in the U.S. Live from Bloomberg's World Headquarters in New York, I'm Scarlet.
I'm Matt Miller.
And I'm Oliver Rennick. U.S. stocks are fluctuating while treasuries tumbled and the dollar rose to a 7-month high.
But the question is, what'd you miss? Earnings season is in full force, and two of the most valuable internet companies are reporting in half an hour: Alphabet and Amazon. Those numbers as soon as they cross. Plus, America's favorite pastime may not be a favorite anymore. The NFL is seeing double-digit declines in television viewership. Is this a blip or something worse for the league? And world-famous shopping strip Fifth Avenue, right here in Manhattan, sitting pretty empty because of the rent. We'll look at dynamics hurting rents in the most prestigious shopping district in the world.
As you head towards the close, let's check out what's going on with the major averages right now. A lot of red, not too deep in the red, but still red across the board, with the Dow Jones down about 10 basis points. S&P 500 down a little bit more, and the NASDAQ again leading the losses across the market. Also, we mentioned earlier, bonds down a little bit, so you've got that stock bond sell-off still happening. Let's find out what's going on with those tech companies at the NASDAQ, where Abigail Doolittle is standing by.
Well, certainly lots of red here for the NASDAQ, Oliver. We do have the index down about 0.7%, near session lows, down 3 days in a row, and in fact on pace for a nearly 1% decline on the week. So some bearishness here for the NASDAQ. Now, one of the big drags today, Alphabet. Shares are lower ahead of the internet giant's earnings report tonight after the close. Investors are looking for $8.61 in adjusted earnings on about $18.2 billion in revenue. And the story here is that despite tough comps, most analysts are looking for an in-line, even a better-than-expected quarter, a decent guide. They're expecting it to be driven by strong mobile advertising revenue growth. And just recently, as we all know, the stock put in new record highs, suggesting that the pressure is on Alphabet to meet or beat. When we go into the Bloomberg and we take a look at BTV4571, we see a beautiful uptrend over the last 5 years. This tells us just how bullish investors are. They really like this company and its prospects. We also see that just recently the stock put in a golden cross. This is when the 50-day moving average moves up through the 200-day moving average. The last two, one in 2012 and one in 2015, proved to be really pretty bullish. So this is not really a tell so much on the quarter and the guide. There could be some choppiness ahead, but over the medium term, Oliver, Alphabet appears to be positioned from a technical perspective fairly bullishly.
All right, Abigail, and right under Alphabet, over your left shoulder, I see Amazon, and I want to know about them because obviously that's a big mega cap that's going to be reporting after the bell.
Absolutely, Oliver. And similar to Alphabet, Amazon has recently put in all-time record highs, too, as analysts become increasingly more bullish on Amazon's prospects around its cloud business and e-commerce. Many analysts just recently have taken their price targets above $1,000. This includes Goldman Sachs this past week. So relative to what investors are looking for, relative to earnings, they're seeing 78 cents in adjusted earnings on about $32.7 billion in revenue. The cloud growth is expected to be a big driver. A survey that Bloomberg did of 6 analysts suggests that the revenue there should come in north of $3 billion. But one question mark here could be investments. Both BMO Capital and Needham are raising the question of whether or not the company is spending on investments as it has done before for future growth, and that this could perhaps eat into consolidated operating income. And when we do go into the Bloomberg, there is perhaps a case to think that things could get a little rough here for Amazon. BTV3735. This is a one-year chart. We see, or year-to-date chart, excuse me. We see a nice uptrend, but we also see just recently that the stock is starting to push under that uptrend. Tells us about investors' uncertainty, and if there's anything that's not great about this quarter, you can certainly see some near-term selling for the shares of Amazon, Oliver.
All right, great stuff. Abigail Doolittle at the NASDAQ. Thank you. And with roughly half of S&P 500 members having reported so far this earnings season, it looks like the longest earnings recession might be over. Some beats across the board. You're looking at an average earnings growth of 2.6% in the S&P 500. That is helping
this quarter
beat estimates. Right.
Because the chart that you're looking at there actually shows you 1, 2, 3, 4, 5, 6, 7 declines in earnings, or at least analyst estimates
there you go.
declines.
Right. So we basically what we're looking at here is the fact that companies typically are going to beat their estimate. We had a very small decline decline priced into the market from analyst estimate this quarter, and we're going to surpass that. I think that was generally the expectation, and this, of course, is a big deal, mostly symbolically, right? This is not a huge positive move in earnings. What it does mean, though, is that for folks that were worried that that was going to keep moving lower and that sort of bottom we had was indeed not going to be bottom, doesn't seem that's the case, at least for now.
Right. With the companies reported, it looks like they're turning it around. It looks like actually 5 quarters in a row of actual declines in earnings.
This would have been the 6th.
This would have been the 6th, exactly. But if you take a look, companies beating EPS estimates, so far 78% of those reported, and you pointed out that almost half of S&P 500 companies have reported. Revenue growth, we're looking at 72% of those reported that have posted revenue growth, and the average earnings beat or growth, I should say, has been 2.65% versus a shortfall in the estimate of 0.4%. You have the EA screen up already, Scarlet.
Yeah,
this is the easiest way to look at it.
This is the best way because it really just puts everything on one screen for you to look at. And as you mentioned, Matt, that 2.6% earnings growth is what you see here in this column. And, of course, sales growth is up about 2% as well. Now, you can also see how it shakes down by sector. And here we have real estate, the winner in terms of sales growth. The Real Estate Investment Trust, basically a new sector group within the S&P 500. On the profit line, right now it's materials, but keep in mind that you still have a lot of companies due to report in the materials sector, not to mention that energy, which are looking at big declines here so far, 94% down in earnings growth, 18% down in sales growth. They haven't really reported. Chevron, Exxon due to report tomorrow morning. Now, in terms of big movers this earnings period, we've seen Netflix jump 19%, the best one-day performer after its results on better than expected subscriber growth. And Edwards Life Sciences, we talked about that yesterday, disappointing sales result and forecast. That stock dropping 17%.
I think it's interesting to point out the energy sector because they've got pretty easy year-over-year comps right now. So the beat there is kind of a given.
Point.
But that's not going to be around forever. So let's keep that spotlight on earnings. And we'll find out what does corporate America's report cards say about the future of the U.S. economy. Let's ask Michael Kelly. He's the global head of multi-assets at Pine Bridge Investments, and he joins us now. Michael, so as we were just talking about, we are sort of turning the corner here for earnings. This is important because we have been in this sort of earnings recession, which oftentimes does come before an economic recession. Is that in the cards here, or are we out of the woods?
Well, we don't think so. We think it's a mid-cycle pause. There'll be several years ahead where we'll see much higher earnings. So, as you know, this earnings decline was primarily commodity-led, and that has flushed through the system now. It looks to be much better. China is always talking about supply-side management. They're never doing it. This time around, they did do it, and commodities are stronger. The United States, the period of deleveraging, which has been going on now since 2009, is over. If you look at bank loans, the big banks reported their loans are growing 8%, nominal GDP is 5%. We haven't seen that in a long time. China's doing better, the United States is doing better, commodities are firmer. So we see several years ahead, really, of earnings growth.
But we have, look, we haven't had a recession since the Great Recession, but we've had really tepid GDP growth. What moves the needle from 1% or 2% and brings us back to a normalized 3% or even the 4% that the optimists and the Republicans are saying they'll bring us to?
Well, I'm not sure we have to get to 3 to 4%. That would be nice. That's not really in the cards. We would say the environment will be less slow. We've been in a feeling that has been very much like quicksand during the period of deleveraging. It was always softer and squishier than you would have thought. And when that deleveraging stops, it's almost on cue with the Reinhardt-Rogoff. This time is different. While deleveraging proceeds, it's always softer and squishier. That is now behind us, at least in the United States. So less slow is the prognosis, and that's a little bit better. Will go a long way, but it's going to go for a long time. It's going to be a number of years.
That's a very measured way of putting it, less slow. What does that mean for investors and how they allocate their money? Is asset allocation dead when you look at volatility and it either spikes all in concert or it all falls at the same time? And we have on my Bloomberg here, the cross-asset volatility measure. It's been dropping along with stock volatility and Treasury volatility.
Well, Treasury volatility all of a sudden is back today, isn't it? So
just by touch.
We have too much money looking for too little EBITDA in the world. It all sloshes to the same favorite 5. and then it goes somewhere else. So we saw probably a bottom in the rate cycle in August with the end of deleveraging, with China back. We do see rates moving up. There is too much money parked in these very safe places in the bond market and sort of safe stocks. And so a large rotation lies ahead.
And a lot of cash on the sidelines as well.
Yeah. I guess the question is that cash going to be enough to keep whatever rotation happens from going further down? But I want to talk.
We were talking about BlackRock estimates more than $50 trillion in cash.
Right,
So
a lot of cash.
It's a lot.
Is whether or not anybody wants to do anything with it. So you talk about the rotation that could happen. Is some of these sort of yield areas of the market get bid up quite a bit. I'm looking in your fund, and I see that you have a pretty big stake in high yield, right? More than 10% of one of your main funds. How, when we see recently, today's another example where even though it's a small move, you have stocks, you have bonds moving in the same direction. What I've actually noticed is that it's very curious. If you look back the past 3 months, the stock market has actually, the S&P 500 has had a closer correlation to the 10-year Treasury than the high yield fund HYG has. What's driving the high yield market right now if it's not just purely rates?
Well, when you quote the S&P 500, there are a lot of bond-like stocks in the S&P 500. So we've had a lot of cross currents going on. More economically sensitive stock markets, small cap stocks, value stocks, they're acting more like high yield. They're sensing that better times lie ahead, not boom times, just better times. We've been through a very fearful period.
You know what? I alluded to Republican promises we've heard during the campaign.
Yes.
Donald Trump says he's going to get a GDP back to 4%. Before him, remember, Jeb Bush was saying that at the beginning of the campaign. I don't want to ask you if they can or how serious that kind of promise is, but I want to ask you how important this election is to markets. Do you think markets have braced themselves for a potential outcome? Have they managed to hedge out that risk? Is there any?
Well, markets are clearly ruling out a Democratic sweep, and they're clearly ruling out a Trump presidency. So whether we have President Clinton with the Senate or without the Senate, the markets, from a market perspective only, that's not a consequential election because the markets think that that's status quo. I actually happen to think the markets are thinking of the last handful of years where a Democratic president was either unwilling or unable to try to make deals with a Republican Congress. Clinton 2, we're now seeing Clinton 3. Clinton 2 was very able and very willing to move things through with a Republican Congress. So I do think it will ultimately be a consequential election. But from a market perspective, for the next several months, they'll just treat that as status quo and it'll be a yawn.
All right, Michael, great stuff. That's Michael Kelly, Global Head of Multi-Asset and Manager Selection at PineBridge Investments.
Coming up earlier this hour, we told you that a team of Citigroup's derivatives traders is said to have generated $300 million in revenue this year trading derivatives. The windfall said to have been produced by the bank's U.S. dollar interest rate swaps desk. We'll have all the details you need to know about those trades. This is Bloomberg.
All right, let's get back to that breaking news over at Citigroup. Bloomberg News reporting that a small team of derivatives trader at the bank generated about $300 million of revenue this year. This is according to people with direct knowledge of the matter. Bloomberg's Dakin Campbell broke the story, and he joins us now. And this was produced by the bank's U.S. dollar interest rate swaps desk. Is this unusual, this kind of windfall?
It is on Wall Street this year for swaps trading. We think this is the number one, maybe the number two desk on the street for trading interest rate swaps, which in the last couple years have been traded much more electronically. With the advent of new rules after the financial crisis, that pushed a lot of these derivatives trades onto electronic platforms, and they get cleared now. So that's given Citi a chance to do a lot more volume in this business.
So my question is the same as I had when we had the story about the Goldman trader. Is this prop trading? Because, of course, banks are supposed to phase out their prop desks.
They are, and certainly I think if you ask Citi, they'd say no. If you ask Goldman about their guy, they'd say no. Banks in this day and age are certainly holding positions for a smaller amount of time than they did pre-crisis. That is directly related to the Volcker rule. So to the extent they're taking inventory, that's sort of how you made money in prop back in the day. Citigroup is trading these swaps much more frequently. They're turning over, during the day. I think in some cases they might carry a position over night, but it's a much more higher volume, higher turnover business.
As opposed to the Goldman Sachs story, which was one of the most read stories instantly. Thomas Malafront, I think, was the name of the trader who was buying junk debt, right? And made a huge profit on it.
Earned more than $100 million for Goldman.
That sounds like less of a service to clients and more of a bet for the bank, you know?
Yes, it does. And cash bond, I mean, this is derivatives. Citi is derivatives. Malafronte is cash bonds. They hold those in inventory. So to the extent that he was able to hold those as the market went up over days or in some cases weeks, he made money on that. He would tell you if you asked him, I'm sure, certainly if you were with the New York Fed, I'm holding these to meet near-term demand for clients.
All right, so we've got Malafront from Goldman. We've got these guys from Citi's interest rate swaps desk.
Ledbetter, Gottlender, and
Right.
Zaguskin, right?
That's right.
So with all this
Jeff
talk
Weber,
about how
who
hard
runs
it
the
is
business.
to make a profit in the post-Volcker world, seems like it's still possible.
Yes, certainly.
Is it just a matter of creativity? Is it a matter of stretching the rules? What is it exactly that these guys need to do?
I want to be a little careful here, but I think it's what you're seeing now is maybe the fruits of years' worth of restructuring Wall Street businesses. Coming out of the crisis, as we knew, the banks had to fire a lot of people. They had to figure out how they were going to make money with new rules, with the Volcker rule. And you're starting to see this year, markets are starting to come back, but you're also seeing banks have sort of finished their restructuring. Now they've positioned themselves a little differently, and so that's how you're seeing, or that's why you're seeing these big revenues.
All right, I guess that we know one group at Citigroup that's looking forward to bonuses.
That's right.
This season. All right, Dakin Campbell, thank you so much of Bloomberg News.
Most read story of the last hour. Of course, people are clicking on that and want to read about that. Now, it's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now, starting with CenturyLink. It's said to be in advanced talks to merge with Level 3 Communications. A deal could be announced in the coming weeks. That's according to people who decline to be identified. Level 3 has a market value of nearly $17 billion, and CenturyLink is worth more than $15 billion. Altria, the maker of Marlboro cigarettes, says it will close manufacturing plants in Pennsylvania and Illinois, affecting about 580 workers. But Altria didn't say how many of those workers it expects to lay off. The closures are likely to be completed by the first quarter of 2018 and will save the company about $50 million. They've got over a year to look for another job. That's your Business Flash update.
Up next, what do Jason Bourne and Star Trek have in common with UK GDP? We'll show you how the box office is saving Britain's economy. This is Bloomberg. I'm Oliver Rennick. Alphabet reports after the bell, so we picked out our favorite Alphabet charts for this Numbers Don't Lie. I'm going to start off by looking at the company's reliance on ads, which is very clearly illustrated by this white line that's just leagues above these other two here, which are showing the traffic acquisition costs and revenue from licensing and other products. However, there's one thing I want to point out. Even though the trajectory here of the ads is very, very high, obviously up to almost about 20 billion in revenue, there's a pretty important tick up here in the orange line, which is showing that the other business from Google has actually been doing pretty well, Scarlet. It's a small tick up relative to obviously this huge line on top, but it is showing a little bit of improvement and to some degree a bit of diversification. And
that's a really good point, because it's not just advertising. Google is trying to get into other things, such as the cloud as well, because as every big tech company knows, you need those recurring revenue streams like the cloud to kind of take over from your proprietary business. And of course, advertising, as good as it is, Google has to give something more back to investors, not to mention fund all of its moonshot businesses as well, whether it's the Google Fiber or
which
the Nest
they might be
business.
cutting back on a little bit right now, it seems like.
They're cutting costs there because it's not exactly paying off the way they wanted to. All right, for me, I'm looking at how Hollywood seems to have saved the UK economy in the post-Brexit vote quarter, in the third quarter. So UK GDP rose 0.5% in the third quarter. That was faster than what economists had been looking for, which was a little bit lower than that. Services jumped 0.8%. That's the yellow bar there, and that offset declines in production and construction, which is the orange bar and the blue bar. And Matt, we really want to show what happened in the third quarter because that's the big boost up in services. So what exactly happened in services? Box office receipts for summer movies like Star Trek and Jason Bourne. So the UK GDP number coming in better than expected because of things like people going to see movies. Of course, this is only the first take. You get 2 more revisions of UK GDP, which may show something different. The big question for the UK, Matt, and the Bank of England is what they do with interest rates, because if the economy is doing better than expected,
I thought you were going to say what the Christmas box office season looks like.
Oh, that too.
Because that'll be very important to this economy, especially not building anything or producing anything. I'm taking a look at the Eurozone, so unrelated in its currency relationship and soon to be unrelated in its legal relationship as well. Pessimism has turned around for the euro. So this week the euro fell within 1.3% of its yearly low, and that was on Wednesday. Today we've seen really a turnaround, and really over the last couple of weeks seen a turnaround in puts and calls. This is a look at 1 month option, and it's bearish when puts are more expensive. It's bullish when calls are more expensive, and you can see that we've seen a real turnaround and risk reversal here. So it looks like people are guessing the worst may be over for the single currency.
We may just be at an inflection point. All right, the market closes next here in the U.S. Take a look at the major indexes with less than 4 minutes to go before the close. All red. This is Bloomberg. away from the closing bell. What'd you miss? Not much going on in equities. Stocks fluctuating on mixed results, but a lot happening in global debt. Traders sending bonds close to their worst month since 2014 on speculation the global economy is becoming strong enough to withstand a shift away from ultra-easy monetary policies. I'm Scarlet Fu.
I'm Matt Miller.
And I'm Oliver Rennick.
We want to welcome all of our viewers around the world tuning in live on Twitter. You can watch our closing bell coverage on Twitter every weekday from 4 to 5 p.m., assuming that you're technologically adept at such things.
I'm not.
I don't really know how either, to be honest.
Sign in. Type in Bloomberg, you'll find it.
Oliver could do it without even knowing how. But
Thank
for
you,
us,
Oliver
the old
Rennick.
people here,
All right, let's begin with our market minutes here. U.S. stocks closing lower ahead of tech earnings, but it really didn't feel like it was a very interesting day when it comes down to it because of the movements. 8 out of 11 major groups finishing down. Real estate, the laggard here, because that, of course, is a new sector that we've been talking about. Telecom, the best performer, so a little bit of that move towards the defensive. Oil prices rising about 1% as well.
On real estate, as you showed us, real estate's done really well this season on earnings, but there weren't a lot of real estate earnings out. And earnings have really been driving the mood of equities every day. Take a look at the IMAP on the Bloomberg. It's the best way to see which industry groups are moving the most. Here you can see real estate, the big loser, as Scarlett points out. Telecom's the big winner. Just so you know, on the fly here, EA-GO is the best way to look at earnings. Smack in the middle of earnings season. You can check that out also by industry group. You can see by surprise as far as the street's concerned and as far as growth is concerned as well.
All right, we have some Amazon results coming across the Bloomberg wire here. Third quarter earnings per share was 52 cents. Analysts were looking for 78 cents. I'll need to check whether that is comparable or not because that would appear to be a gigantic miss. But again, third quarter earnings per share right now, 52 cents. And it looks like that's what investors are taking it to be because the stock is down by 8%. Wow. In terms of net sales for the period, $32.7 billion. That was higher than what analysts had been looking for. They anticipated 32.65. Okay, so if you round it up, pretty much in line. Operating income for the period was $575 million. According to analyst consensus estimate, it should have been $690 million. So that looks to be a big miss. So perhaps Amazon is going back to the idea of profitability being less important than goosing sales.
Let's talk about their outlook as well here because they're talking about fourth quarter operating income of about $1.25 billion. That's lower than the estimate of $1.7. Pretty big drop off there. In terms of their sales, they're estimating between 42 and 45.5 versus about 44.7. So the high end of that estimate is still where expectations were, but they're also giving a very low range to that as well. So the outlook not looking so hot there, and we know that that's always key.
All right, let's bring in Shelley Banjo, who covers retail for us. She's a columnist at Bloomberg Gadfly, our fast commentary section. And Shelley, when we look at Amazon, we consider the results. How important is profitability and building on EPS growth every quarter, every year to Jeff Bezos?
I don't know how important it is to Jeff Bezos, but it's certainly been what's propping up the stock so much because people were, for a long time saying this company is never going to do profits. And then about last year when they started breaking out how much AWS was giving to them and giving profits to them, that's when you really saw the stock take off from, around 300 to, 800 where it is now. But Bezos has done this before. He's shown you that he can do profits, and then he'll pull it back and say, you know what, I'm actually going to take some of that money, invest it into some huge projects that he's working on.
All right, so we have Shelley Banjo here from Gadfly. GADF is how you get her stuff on the terminal. If you type in BI on the terminal, you get the Bloomberg Intelligence platform. Paul Sweeney runs that, and he's here as well. Paul, Shelley makes a point that that's been propping up the shares' expectation of climbing profits, but long-term investors know that Jeff Bezos can take it away whenever he likes, and they have faith in him, don't they?
They do, and I think Shelley's right. We kind of, as shareholders, we kind of got used over the last several quarters of actually seeing profits and growing profits at Amazon. It had been years since shareholders had seen that, and again, a lot of that was driven by the growth of the cloud business, which carries operating margins in the mid-30s, relative to almost no margins at the core retail business. So, I think what happened is, Amazon investors got a little bit used to a profitable earnings tape coming across every quarter. And here we go now with kind of dialing that back a little bit. So we're going to see a short-term hit here, but I think still the long-term story for Amazon. The bulls, I think, are still going to be on top of this story.
All right, we also have results from Alphabet, which is the parent company of Google. If you look at revenue ex-TAC, which is the revenue that it passes on to partner websites, that came in at $18.3 billion, better than what analysts had been looking for. They were expecting $18 billion flat. Adjusted earnings per share for the third quarter, $9.06. The consensus estimate was for $8.61. And, of course, Alphabet gets most of its revenue from advertising. So let's talk about the paid clicks. That dropped 5%. That rose 33%. The consensus estimate was for an increase of 26%. The cost per click declined 5%, and that is a little bit more than what analysts had been looking for. Down 4.8% was the consensus estimate for Alphabet's cost per click.
So let's take a look at the shares here. We saw initially a big spike up and then a drop. Investors look like they're taking a moment to figure out exactly what's going on with Alphabet shares. We can see, though, right now they're at $15. It's about 2% after hours. So the shares, which you can see here, gaining 2% after hours, GPCT, YTD is the best way to see what they've done year to date. And we can see they were up about 5% and have fallen a little bit recently. I also like to look at the comp page. It's one of my favorite things to do with an equity. And we can see that Google has outperformed over the past 5 years with reinvested dividends. The S&P 500 index by a long shot. Google or Alphabet shares here in white, the S&P 500 in orange, but it's just keeping up with the IT sector in the S&P 500.
I want to add a little bit of color on the sort of bullishness behind the stock and perhaps why it's sort of hard to get a big boost here. I mean, when you look across the street, it's overwhelmingly bullish. Wall Street analysts, there's 44 buys on Google right now, or Alphabet rather. There's only one sell among all that group. Paul, question to you. When you look at sort of the movement here, you're trying to figure out all these analysts that are bullish on it, where is the biggest room for error that Alphabet could potentially miss out on here that's going to cause people to say, okay, here's the one part I was worried about. They're not living up to that.
Yeah, it's interesting. Today really is the A-team with Google or Alphabet and Amazon, really the two big, I think, highest quality tech names out there. Investors feel most comfortable with the growth story. But as you suggested, I think to the extent that there's any concern here for Google, it might be for some of their new businesses out there. They've broken apart some of their new business outside of their core search business. And the question is, will any of those new businesses really hit and become a big business for them in the future? Because you take a look at the valuation, there needs to be a longer-term growth story here as well.
And speaking of those new businesses, it's counted as other bets in the income statement. Revenue from other bets increased to $196 million from $141 million a year ago. Losses narrowed to $865 million from $980 million. So things are moving in the right direction, but this is not going to be a big contributor, is it?
No, and we're really talking about the core search business, and you mentioned the cost per clicks are down, but the number of clicks are up dramatically. And that just reflects the migration from the desktop to the mobile environment, which I believe Google is managing very well, but the dynamics are a little bit different there in terms of pricing. But what continues to grow this story probably over the next couple of 3 years for the bulls is YouTube and this continued migration to mobile, and as well as the cloud. The cloud is becoming a bigger piece of the business for them, not as big as it is for Amazon, but it's certainly a part of it.
I wonder, is it just my perception, or does Amazon do a lot better in the other bets category, Shelley? I mean, Jeff Bezos in the earnings release today is saying Alexa may be Amazon's most beloved innovation yet, literally with over 250,000 marriage proposals from customers and counting. And he says she's just getting better because her brain is in the cloud. He's talking, of course, about Amazon Siri, which a lot of people have really grasped onto, but they have also Amazon Prime, which has done very well. I watch a lot of their series. They're challenging Netflix. They've done so much more, it seems like, and so much more successfully than Google has outside of search.
Yeah, I mean, AWS is about $10 billion business. And Bezos said, I think today or yesterday, we had 7 years where we didn't have competition over here. But, competition is coming. Google, Microsoft, they're not even quite as big as Amazon, but they're definitely coming, and they can get into that business. But AWS is so important to Amazon because that's where they get all the money. That's where Bezos gets all the money that he can play with to make those things like Alexa and everything like that.
We're showing a chart here of Amazon Prime members. This is kind of an estimate because Amazon itself doesn't actually disclose how many Prime members it has, but you kind of figure that there's a certain base of customers it can draw from, and at some point that growth is going to slow down. Has Amazon monetized this base as much as it can?
So I wrote a column today exactly looking at that. that, which is what happens when Amazon hits prime peak. So, or peak prime rather. And so, there's 200 million people in America. How many of them can have, right now we're at about 30% with Prime members. If you take out the married people, it goes to 46%. That's a lot of people. So I think part of the reason why Amazon hasn't actually laid out how many Prime members it has is because at a certain point, it's going to hit that peak and it's going to have to switch strategies from just signing up people to Prime to getting more and more money out of that Prime. And that's where all those other things come in that Matt referenced, which is how do I get this to be stickier? How do I get Prime members to spend even more money with me?
Shelley, when you look at what the top line numbers here, revenue is pretty much right in line. It's the earnings here that missed at least going by GAAP, the estimates a little bit. So it's a bit of a discrepancy. Something happens on the way from making the money to delivering it back to shareholders. Where are they looking to sort of, tighten up some of those costs that are eating in there?
Well, shipping is a huge cost for them, and it's been increasing quarter after quarter. And that's where you're starting to see Amazon get into this business of we're going to take on UPS and we're going to take on FedEx, whether it be planes, trains, drones, whatever, what have you. And, that is a huge, both an expense and also a potential way to cut costs. But in the short term, it still will be an expense.
So, Paul, final comment here on Alphabet. When we look at how much the company is spending, investing in its business, CapEx will be $2.55 billion, or it was for the third quarter. The consensus estimate was $2.65 billion. Does the trouble that Alphabet has had.
We need to remember which one. We should hold up a sign.
I know.
Right.
Google.
You're talking about Alphabet
that?
or Google. We were talking about Amazon.
Does the trouble that Alphabet, Google has had with some of the other bets mean that it's going to be less aggressive about expanding into other business lines?
I don't think so. I think they've got a very good handle on their business, and we have to give a lot of credit to the new CFO, or relatively new CFO at Alphabet, Ruth Porat. One of the things that she's brought to the company is operating expense management control, and really a little bit greater focus on cost control and margins, as well as capital allocation between CapEx, existing businesses, new businesses, and then returning cash to shareholders. Both of those things, operating expense and capital expense discipline, have been really well received by shareholders. And I think that's going to be very important for this company going forward. And it's what this company really needed. And we've seen since she's joined, the stock perform very, very well here.
Absolutely. All right, just to recap here, we've got Amazon shares declining after third quarter earnings per share misses analyst estimates. Year over year, Amazon Web Services revenue growth slowing as well. You can see it's down by 6%. Meantime, Alphabet shares have been bouncing around a little bit here. Revenue and profit topping estimates on the strength of its ads, but everyone's still kind of sifting through everything here, especially as Alphabet makes that shift towards more mobile device-generated advertising as opposed to desktop advertising. And, of course, we have to thank our guests.
Yeah, so thank you very much, Paul Sweeney. I've been looking into Bloomberg intelligence data all day. You can see that under BI Go. Shelley Gadfly, great story today on Shelley Banjo, great story today on Gadfly, GADF. Go to get to that. Coming up next, we're going to head to Toronto and speak with the Ontario Teachers Pension Fund Plan Chief Investment Officer, Bjarne Graven Larsen. Eric Schatzker is there at a conference. He's going to be doing that. We'll ask him what he's looking for to move the needle on his $170 billion behemoth. Let's head up to Toronto now, where Bloomberg's Eric Schatzker is standing by at the Capitalize for Kids conference. He's with a very special guest, Bjarne Graven Larsen, the CIO of Ontario Teachers Pension Plan. Eric, take it away.
Matt, thanks very much. Ontario Teachers is one of North America's largest pension managers, has $170 billion in assets. Bjarne, thank you very much. Good seeing you.
Pleasure being here.
I have to begin with the one question everybody wants to ask a pension fund CIO right now. And in fact, Cliff Asness, whom you know manages AQR and himself runs $170 billion, told me this is exactly what he would ask. What are you doing about hedge funds?
Well, we're doing a lot about hedge funds. I guess one of our panelists here today at the conference is running all of our hedge funds, and we have a very strong relationship with hedge funds. Changed over time, though, because some years ago we used to think of them as someone that would invest our money for us, but it has actually changed a lot, and we have fewer relationships today, but they are much more strategic in nature, and we're really trying to use hedge funds as a source of information, sharing information with them, and a much more integrated part in our investment philosophy today.
As you know, there's a prevailing narrative that pension funds have had it with hedge funds. CalPERS has exited or is exiting its hedge fund portfolio. Rhode Island is dramatically reducing its hedge fund portfolio. What are you doing about your hedge fund allocation?
It's more or less unchanged, but what has actually happened is that we have shrunk the number of relationships, and so fewer but larger and more significant relationships, and really, as I said, focusing on getting access to the smartest people, because a lot of the smartest people on the globe, they're actually working in the hedge fund industry. Still working there. The fee structures are probably going to change, the relationship is going to change, but really I feel that we have a lot of smart people. That's our biggest assets in Ontario Teacher, but we need to be able to have long-term strategic relationship with smart people out there, and there's a lot of them in the hedge fund industry.
Now, while maintaining those relationships and tapping into those smart people, are you at the same time questioning the structure of some hedge fund vehicles and the value that you derive from the fees that they charge?
There's no doubt that the 220 and all that has been discussed a lot over time. And
is it dead?
It's probably still alive, but it needs help to stay alive, probably. I think we are...
Returns would help keep it alive.
Returns would help, and the 0% interest rate is probably not helping the model either. So I think it's changing. We have more focus actually on seeding newer funds and doing stuff where you actually focus more on the comp part that is related to the 20% and the 2% in management fees. I think we like to actually reward people that do great things for us, but we like to reward them for their performance and not just for managing our money.
So you like emerging managers, so to speak. Are you redeeming at the same time from some of the larger managers?
It's not really large or emerging. It's more a question about the relationship and the people. So you can't put it like, it's not black and white. It's both or none.
So to finish on hedge funds, based on your experience, the approach that you're taking and the value that you believe you're still getting, are those pension funds, and there are many, that have given up on hedge funds, wrong?
No, I don't think you could say so. We have a capital markets department, a big trading desk ourselves, and a lot of people do some of the same things that you do in hedge funds. And those people, when I talk to them about where they really benefit from the hedge fund, is the sharing, the idea that it's not a question about taking your money, giving them to an asset manager, and then they do something for you. It's actually a question about having the dialogue, trying to figure out why is it that these people continuously are able to get great returns for us. So that's really the reason. We have a lot of internal people that thinks in the same way, and they benefit a lot from having relationship to these people. So I think not all pension funds are set up with a huge capital market department that do trading on their own.
Now let's talk about publicly traded securities.
Yeah.
If your private equity investments can earn 30%, and they did, and your real asset portfolio of infrastructure and property can earn 13%, and it did, what's the rationale in a zero interest rate world, as you just said, where returns are low, but your liabilities don't change? What's the rationale of investing in publicly traded securities, particularly fixed income?
Yeah, I think what you can say that do we like the private areas, or in general actually the areas where you can have a long time horizon and you can match some of the strategies to your liabilities? Yeah, we like that. We have 58% in illiquid assets today, and we are planning on taking that even to 64% or so real estate, in infrastructure, in private capital, because we have a lot of smart people there and we like the asset classes. But we like liquidity as well. You know, you don't want to be in a situation like 2008, having swaps out there, derivatives, and not having enough liquidity actually to be able to post the collateral you need. So we are very, very focused on having a truly diligent process on not being too illiquid, so we will get into problems. So we like the liquid market for their liquidity as well.
That said, just to do the math, you are nevertheless planning to shrink your public securities portfolio by several $billions.
We are, but that's not because of the the liquidity, the illiquidity. We have done a lot of things to make sure we have enough liquidity. It's due to the fact that we are better at creating value add in the private areas. As you said yourself, we have the 25th anniversary for our private capital program, plus 20% over 25 years. It's difficult to compete with that. So we like that. We like to do more, but we want to make sure that we are always liquid so we can always fulfill our liquidity requirements.
You're a global investor. Surveying the world as you do, where do you see the best opportunities to generate returns?
I think it's really people. That it comes down to people and getting access to the right people. We've been used to being like a powerhouse in Toronto, I would say, with a lot of well-educated people here, and we have access to them, hiring them, retaining them. But we figured out we need opportunities globally, so we opened a London office and a Hong Kong office. And the way you source good deals there is by building long-term strategic relationships with guys in Asia, in Europe. To do that, you need smart people working for you. So that is really what we're looking for. We're looking for the right people to staff our offices in London and Hong Kong, and then the opportunities, they will develop over time. But focus on relationship before you focus on how to do the next deal.
So I asked you about opportunities. It sounds to me like the greatest opportunity is also the greatest challenge. Is hiring good people the biggest challenge? Beyond hitting your bogey, which every pension fund has to do every year?
I think that if you ask me, is there one thing I spent most of my time on right now, that would be people. It's not an issue now. We have a lot of great people. We can still hire good people. But you see a lot of sovereign funds. You see a lot of pension plans. You see hedge funds. You see...
There's competition in
There's a lot
words.
of competition. Toronto, it's easier for us to get access to all the smartest people. But when you have offices in London, you have in Hong Kong, you really need to make sure that you have a value proposition for those people that makes sense when you compete to the Blackstone, the KKRs, the Morgan Stanley, the Goldman Sachs of this world. So the competition about people is more fierce in London and Hong Kong than it is here in Toronto.
The war for talent continues, in other words.
It continues, and that's really where I think we can differentiate ourselves. A lot of young people today, they like working for pension plans because there's a truly meaningful purpose there. If we do well, we can do great things. We can be number one. We can recognize for that. But we can actually make old people in Canada have a retirement that's much better than if you work for a different kind of financial institution. So making a truly meaningful purpose very clear to your employees, that matters.
Bjorn, did you ever think 15 years ago you would be sitting here today saying young people, they really like to work for pension plans?
No, not really, because it hasn't. Maybe in some part of the world it has been okay. In North America, except from Canada, it has been more difficult. But it actually, young people are changing today. They're not only into money, they're into family, they're into family values, they're into purpose. They really want.
And that gives you an advantage?
I think it gives us an advantage because I've been a CEO in a bank back in Europe when I worked there. Even though I tried for 3 years to come up with a truly meaningful purpose for the bank, it was much more difficult than in a pension plan. So I think in that sense we have a truly meaningful purpose we can use, and we have long-term money. We do not need to flip our portfolio every year or every 5 years. So the long-term part as well, I guess, gives us an advantage, but it's not going to be easy because there's a lot of smart people out there.
Now, as we've alluded, Ontario Teachers was a pioneer in the pension fund industry. Mm-hmm. It developed a direct drive model, bringing the investing activity in-house and doing it yourself, including private equity investments.
Yeah.
How does Teachers innovate next? How do you stay at the vanguard of what a pension fund needs to do to deliver the best returns for its beneficiaries?
I think we try to continue to do what Ontario teachers before I joined have been doing so well for 25 years, continue to focus on hiring the right people, expanding globally, building relationships in the private area. So we expand where we came from, but we're not resting on the laurels. We try to figure out what's next. And one thing that we figured that we needed to change a little bit is the top-down approach to the fund, the fact that are we well balanced in the total fund. So we are actually changing our asset mix right now. We are introducing more like all-weather kind of portfolio measures from the top. We are introducing factor models to make sure that we have the exposure to the different underlying factors that drive returns.
You're becoming more quantitative.
I think we have added a top-down layer that's a little bit more robust in all kind of situations than we have before. So we have a quant part of the fund and we have the bottom-up part of the fund. So I think where we really want to differentiate ourselves is doing both, having the top-down view, the bottom-up view, meeting in a way that we haven't seen any pension plan doing so far.
Now, how many pension plans are you aware of that are building those kinds of capabilities?
Not a lot, really, because I think usually either pension plans are really good at one or the other. I think I used to work for one in Europe that was really good at probably the top-down part as well, and is trying to figure out how to do well on the bottom-up part. Ontario Teachers has been doing quite well from the bottom-up part.
Most, it would seem to me, would either go and hire AQR, right, if they wanted smart beta and factor investing, or if they wanted a systematic strategy, they'd go and hire Two Sigma.
Yeah, there's so many. The thing that really surprised me the most by joining Ontario Teachers was the access to talent here. There's so many smart people being educated in Toronto with so amazing skills in the quant area. So we have access to all those people, and at the same time building a culture in 25 years about the direct bottom-up culture. So I think we have an unique opportunity to actually succeed here, and I think that would be unique if you could do both in the same plan, at the same time being focused on risk management and making money even in more dire circumstances than the one we see today.
Bjorn, one question I've been asking many investors over the past several weeks and months is which asset class represents the single biggest risk? What would you say?
I think we're in most plans and pension plans, I wouldn't say an asset class, but the equity factor risk, because people tend to like assets with higher returns, and a lot of them, they are equity-centric. They don't think about, not everyone thinks about the risk-adjusted returns. We are trying to actually decrease our equity-centric focus a little bit, even though we are increasing our private programs, and then looking a little bit more at credit, a little bit more of assets that's sensitive to inflation, a little bit more of, as you said, hedge fund-like strategies or strategies with that diversified the rest. So we're actually trying to figure out the different factors, even fixed income. We're increasing our exposure to fixed income because everyone had been so wrong for so long about interest rate. And, first, they're not going to go to 2%, then they went to 2%, but they're not going to go to zero. Then interest rate went to zero in some parts of the world. And now people say, well, they can't really go to -1 or -1.5. So people tend to base their decisions on their ability to forecast interest rate, and we have been terrible at that. So I don't suggest that we should start thinking that we can forecast interest rate. Better build a robust portfolio that would do well even if interest rates stay low.
Bjorn, thank you so much. Great speaking with you. That's Bjorn Graven Larson. He is the Chief Investment Officer at the Ontario Teachers Pension Plan. Matt, a behemoth in the industry with 170 billion Canadian dollars in assets. I send it back to you from Toronto to New York City.
All right, Eric, thanks very much. Bloomberg's Eric Schatzker up there at that conference in Toronto, one of the biggest in Canada every year. Scarlet?
All right, well, we're, of course, keeping an eye on shares of Amazon because after the close, Amazon reported, or I should say, forecast holiday sales that may miss analyst estimates. So this was certainly a disappointment for those who had driven the stock higher for much of this year. Sales for this quarter, according to Amazon, will be $42 to $45.5 billion. Analysts were estimating $44.6 billion. We saw the shares drop as much as 9% in extended trading, but it has pared some of those losses.
Getting a little bit closer to unchanged, but still, that's a pretty big drop, 4%. I want to touch on LinkedIn real quick. Remember LinkedIn?
Yeah.
Isn't Google,
I thought it was called Microsoft now.
Exactly.
It will be called Microsoft probably by the end of the year, but right now it's still reporting earnings. And it's actually pretty interesting. They beat pretty well, but the share is really just unchanged. I guess people are kind of aware what their future is. The company did not really give much of an estimate looking forward, but profit excluding some items was $1.18 per share in the quarter. That compares with an average analyst estimate of 93 cents. So pretty solid beat there. Revenue as well in the third quarter was $960 million, up about 23% from a year earlier. So pretty solid number there, and also 106 million unique visitors going there this month.
A little nuance. It probably will never be called Microsoft, right?
Right.
I mean,
Correct.
YouTube is not going to be called Google.
Right.
But it will no longer trade as LinkedIn once the deal is closed.
And you might start finding a lot of new Microsoft business.
I asked Siri, when the Microsoft LinkedIn acquisition would close, and she didn't know. She actually Bing searched it.
It's supposed to be, LinkedIn has said by the end of the year they expect it to close.
Got
but
it.
Salesforce is really pressuring regulators to look at the deal.
I just can't believe Siri Bing searched it. All right, Alphabet, speaking of Google, Alphabet came out with earnings and sales that beat analyst estimates to wrap up a triumvirate of tech earnings. Alphabet had $18.3 billion in quarterly revenue. The street was looking for $18 billion. Alphabet had $9.06 in adjusted EPS. The street was looking for $8.61. So beating on both measures there as the search business continues to deliver a ton of revenue and profit and offset the spending that Google or Alphabet makes in its other bets categories, which include, of course, the autonomous driving push and what else have they got? A fiber internet service. Yes. And I just know that because they keep losing executives from those big other bets categories.
Tony Fadell being the first one.
Category.
All right.
Moon shoots. There you go.
Moon shoots, moonshots. Joining us now for more on today's tech earnings, the trifecta is Manas Crespi, Hart & Co. analyst. James Chakmak. He covers Alphabet. He covers Amazon. So, James, let's start with Alphabet. You have a buy recommendation with a $900 price target. When we look at Alphabet, this is pretty much still an advertising company with a couple of other things on the side, isn't it?
Yes, exactly. I mean, the way I think about Alphabet, I mean, the Google core business, it's a billboard, right? And it's a place where you can advertise and also have the most prominent direct response advertising in the world, which is identifying what the intent of the customer is and converting on that. So what we saw in this quarter was not only solid performance, but also an acceleration across all measures from the second quarter, with paid clicks up 33%. That was versus 29% in the second quarter. Meanwhile, you're seeing it across Google sites as well as the network sites. So all in all, it's pretty encouraging to see the trends for the third quarter.
Do you want to see them continue to invest in these moonshot businesses, or are you happy to see some of them lose their executive heads and shrink?
Yeah, it's a good question. I do think that they need to, maintain agility and stay on the cutting edge of new technology. So I'm all for it, as long as the costs are spent in a disciplined fashion. And I think we're seeing that with the operating losses narrowing from last year in other bets. And I think that's something that Ruth Porat has brought to the table as the CFO. But all in all, yeah, I do think that they need to do everything that they can to stay relevant in a disciplined manner.
James, you also rate Amazon, and right now you have it at a neutral. You've had that way since the beginning of the year. Amazon obviously still, despite the losses today, up about 20% on the year. When you think about the earnings and think about the price drop here, do you stay where you are and say this is stock that remains neutral, or is it a little bit more attractive at this price now? Especially
with, I think, 44 analysts have a buy, so you're one of only 5 that has a hold on this stock.
Right, thanks for reminding me.
Well, you might be in a great position. You're in a great position now, James, because the stock is going to tank after this disappointment. The question that I think that Oliver's proposing is, do you take advantage of this dip and get back into the stock?
I mean, look, Amazon is probably the most difficult stock to be neutral on, given the secular trends that we're seeing. But ultimately, to get to the valuation, some of those targets that you're seeing in the 1,000+ range, you have to assume status quo performance and maintaining of that trend in North America, which, okay, give them the benefit there. Give them the benefit also in AWS, which was very solid this quarter. But you also have to give them the benefit of the doubt internationally. And that is very tough to do, considering it's an uphill battle in places like India, which is costing an arm and a leg. So, you can sharpen the pencil, but you need to be quite creative. As far as what we do from here, look, I mean, the numbers just came out. I got to go back, look at the model, listen to the call, and then make a determination after that.
James, how much is Amazon's price rally this year sort of a momentum effect that is a result of so few options in terms of stocks that are outperforming, stocks that offer themselves as growth stocks? Is that what's driving this, and is that dangerous to some extent, in your opinion?
I think initially the first half rally that we saw was about the fundamentals. It was actually revenue posting better than expected and a much clearer path to profitability across all three of the segments. However, I think in the second half of this year, after the 2Q report, I think you hit the nail on the head. And I think it's mostly driven based off of scarcity value of high quality, high growth names that are growing not only in a growing market, but also growing share within that growing market. So it's that scarcity, I think, that kept the momentum going probably a little bit more than it should, which is why I think we're seeing the pullback.
I just want to take viewers into the Bloomberg for a second and show them. You mentioned analyst targets, price targets on Amazon, and it's an average of almost $1,000 right now of the 49 analysts that we cover here at Bloomberg. This is a price chart showing you the 12-month price target in yellow and the actual price in white. Now, Amazon hasn't hit the price target in the last 5 years. The last time it did that was 2011. So analysts are perpetually uber bullish on this stock, and as soon as it rises, they lift their targets. It just never gets there, James.
Well, you've done the math there. I haven't looked at that chart, but you have to assume that nothing stops, and the music keeps playing. I can do that for North America. I mean, I know from my own personal habits, I'm spending more. I can see it in the numbers in AWS from the customers we talk to. The 50% incremental margins there is a real thing where features are driving more demand versus price. And that pricing was an issue historically. It's not anymore. International, I can't get my head around it. And especially this quarter, we went from break even for a long time internationally, but now it was down 3.1% to a negative 3.1% margin in the third quarter. So what's that all about? We have to drill down.
And, of course, James, you also cover Twitter, and Twitter has been in the news mainly because it hasn't been able to line up a buyer yet, and it continues to seek these strategic alternatives. Based on your read of the company and the latest results indicating that quarterly earnings and user growth beat analyst estimates, who would be the right kind of partner for Twitter, and how much lower does the price need to be for that to happen?
Yeah, I mean, thanks for asking that. Basically, I've been shouting from rooftops. I feel like that Disney is the most appropriate buyer for Twitter because not only can it be used as a distribution arm for content, but they can operate it at arm's length so that Twitter could secure their own deals as we move into a cord-cutting world. So I'm standing by Disney as the buyer, as the best buyer for Twitter. As far as price is concerned, giving the benefit of the doubt here, comping against a LinkedIn, which is, tough to do, but even if you do that, you get to a $15 billion valuation, which implies somewhere around $20, $21. I think that would be fair. Anything above that, I think, is overpaying. As far as the quarter is concerned, look, it was a good quarter, but there's still a lot of uncertainty as we look forward.
All right, Jim, thanks so much for joining us. Really appreciate your time today. James Chakmak there, Monnaz Crespi, and Hart Equity Analyst covering those tech stocks for us. Now, let's head over to Emily Chang at Bloomberg Technology. She just finished speaking with a high-level Alphabet executive. Little mystery here. Emily, give us some of the highlights of your conversation.
Hey there, Matt. Yes, just got off the phone. This person I spoke with emphasized the incredible growth of mobile, particularly. Mobile is continuing to drive revenue growth, especially when it comes to advertising. 42% growth in paid clicks, which is the strongest that we've seen at Google, at least in the last couple of years. Again, this driven by mobile search and video growth gaining momentum. YouTube also growing at what this person said was, quote, a significant rate, primarily from TrueView advertising. They're also emphasizing growth that they're seeing in cloud, in Google Play, of course. cloud, a particularly huge bet that Google is placing in the midst of other big heavyweights like Amazon and Microsoft going after the cloud. There's always a great interest in what's going on with the other bets. So things like Nest, Fiber, Verily. We've seen a lot of turnover in the executive ranks at these holding companies. The person I spoke with said that the structure has afforded them new opportunities to really bring some transparency to these various operations, that they believe that it is very important to create technical and financial milestones before they reaccelerate on these various projects. With Fiber in particular, we just saw the head of Google Fiber leave. Craig Barrett, he'll remain an advisor to the company. The person I spoke with said they're continued to be proud of what he has done. They believe that Fiber still represents a huge opportunity, but that what they wanted to do was focus on the potential of the efforts before reaccelerating their deployment. The founders of Google still believe, though, that there is a huge opportunity when it comes to free wireless services, in cities across the country. They're now deployed in 12 cities across the country. But we have seen a lot of turnover in the other departments. Of course, Tony Fadell, the head of Nest, has gone. Bill Maris, the head of Google Ventures, has gone. These are, expensive but potentially high potential operations. When you look at the overall revenue for other bets, it has increased $196 million versus $141 million last year. The loss has narrowed to $865 million from $980 million a year ago. But the person I spoke with cautioned you can't look at this quarter over quarter. You have to look at this over several quarters, and that is how they are, in fact, looking at it. We also spoke a little bit about what's going on with Nest. They're very excited about new hardware opportunities. Of course, the Pixel smartphones will be coming out over the holidays. Google has also announced a new home device to take on Amazon's Alexa. When it comes to Verily, Verily has announced a number of strategic partnerships with pharmaceutical companies that they are very optimistic about. But the bottom line is that the core business, the core Google search business and advertising business is still doing so well that, certainly they can justify the spending and the experimentation that is happening with these other bets.
All right, Emily, thanks very much. Emily Chang there from Bloomberg Technology.
And another company reporting earnings, what's been called the Google of China. This is Baidu reporting fourth quarter revenue. Its forecast for this quarter, I should say. That outlook trails analyst estimates, but the third quarter adjusted EPS does beat the consensus. The stock is down in after-hours trading. Coming up, TV networks are giving away more commercial time now that ratings for live NFL games are not coming in. They're down double digits from a year ago. Why are people not tuning into the biggest draw on television? This is Bloomberg. I'm Scarlet. What'd you miss? A decline in NFL viewers is forcing TV networks to give away ad time. Pro Football ratings have plunged 14% among the key 18 to 49-year-old demographic. What is driving this drop-off? Boomer Esiason, former NFL quarterback and current sports commentator, was at the Bloomberg Tradebook Charity Day today, and he chalks it up to a number of things.
I do think that there's probably a little oversaturation because there's Thursday night, there's Sunday night, there's Monday night, and now there's even Sunday morning London games. So there's only so much you can digest, I think. But the other aspect, too, is that there's a lot of things that go around along with the NFL that I'm sure some people are disturbed by, whether it be the Colin Kaepernick kneeling during the national anthem or another domestic violence issue with the New York Giants. So there's a lot of negative that is surrounding the game sometimes, but at the end of the day, when you really look at the numbers, they're still very hardy.
Here to discuss this further is Porter Bibb, managing partner at MediaTek Capital Partners. He's got over 4 decades experience as a senior investment banker specializing in media, entertainment, and tech ventures. So, Porter, what do you think? Is this decline a blip or an inflection point?
I think it's the beginning of the end for live football on television. First of all, you have to go back to who's watching. 10 years ago, 95% of all American households had television, whether it came over cable or from satellite. That number today is a little less than 80%.
Wow.
Change the demographic makeup of the United States, and you see all kinds of people who didn't grow up with American-style football who are watching English Premier League, watching Formula One racing, they're watching esports. Tens of millions of 18 to 29-year-olds are watching the extreme sports right now. I watch drone racing.
I was going to say, Oliver watches drone racing. He doesn't have a TV. He streams it live on Snap.
Right.
I'm on the drone. No, but so when you see the beginning of the end of live NFL viewership, which is the key part of that sentence? Is it the live part, people are watching it through other mediums, or is it specific to NFL?
Well, it has a lot to do with what Boomer was talking about. There's oversaturation for a start. Secondly, the pricing that the NFL has been getting for the television rights have gone through the roof. And the reason that the networks have paid is because it was the one reliable viewership magnet that they could count on. Well, that's not going to happen anymore because the ratings are going down, the viewership is going down, and it's also going mobile. And the NFL has not figured out how to make it mobile. They signed a multi-billion-dollar deal with Twitter, and who's watching? Nobody.
Was that cannibalizing the TV broadcast?
Yeah, of course. And we're seeing this radical shift to mobile devices, iPads and phones, and the NFL is not part of that. Disney bought BAMTech and is ahead of the curve with Major League Baseball putting it on mobile devices, but the NFL is behind that curve.
So I wonder if we're not measuring viewership correctly. For instance, our producer Tim Andriacci, when he streams an NFL game from his phone or tablet, does that get counted into the ratings?
No, that's one of the big problems because mobile is not a reliable. There's no ComScore and several other measurement services are not reliable, and advertisers don't believe them. They don't buy the numbers. And look, Nielsen's been the industry standard for 50 years, and nobody believes Nielsen. Nielsen has never been able to go over the top and measure mobile and non-linear television audience.
So this decline in NFL viewership ratings, because we're talking about the decline in the measurements that we don't trust, right?
That's correct.
Doesn't necessarily mean that NFL football is less popular even with the kids, right? They're still playing fantasy. They're still looking on their computers to see what the scores and the stats are. They must be going to the games because the tickets aren't getting much cheaper.
No kids can afford to go to an NFL game today. No, I think that the kids are growing up with a whole different perspective on sports, and football is not number one the way it used to be. Look at all the concussion issues that high schools and colleges are having to deal with, and that's driving people away from the sport. So, and all of the minor sports. I'm a lacrosse player, and lacrosse is booming right now.
A lot of kids are playing hockey. Scarlet plays hockey in her downtime.
So it's not just a measurement problem. It's a whole cultural shift right now, and non-American youth who are not born here, immigrants, they don't know anything about football, and they're watching soccer, they're watching other sports
or football.
Or football.
F-U-T-B-O-L.
But the other thing that is really significant is the fantasy sports world, because tens of millions of kids are watching fantasy or doing fantasy sports right now and not paying attention to real life NFL football.
So, Porter, is this a wake-up call to sports leagues or to TV networks?
Both. But the TV networks are struggling right now, with not just with the declining audiences of football, but with the declining audiences of all linear television. They're trying to figure out, as Time Warner has done with AT&T, how to get ready for the next transition in media distribution.
All right, Porter Bibb, Managing Partner of MediaTek Capital Partners. Fantastic stuff. Coming up, we're talking about the most expensive retail streets in the world. This is Bloomberg.
What'd you miss? The golden rule of real estate: location, location, location. But what happens when luxury retailers balk at paying exorbitant prices at some of the world's most prestigious areas? Spencer Levy is the head of research for CBRE Americas, and he's here now with more details. Spencer, what are the trends you're observing right now in terms of pricing at these locations?
Well, I think the headline is this, is that luxury retail has been perhaps the #1 performing asset type within commercial real estate for the last 7 years. And because of that, not only has luxury spend gone up, but so have rents. And while we are seeing some weakness now in certain markets due to exposure to places like China, where spending has increased, but at a decreasing rate, or Miami with exposure to Latin America, you are seeing some downward pressure on rents and maybe some increased concessions from landlords.
And we have a chart here that shows retail rents on Fifth Avenue surging. Merchants are struggling to pay these record rents, especially because you're talking about people who go in and kind of wander around.
Right. I wonder if Fifth Avenue is maybe different than other avenues. I mean, is Fifth Avenue its own little story?
Well, actually, no. There are other avenues just like it in London and Hong Kong and Paris, London, that have similar dynamics. At the end of the day, you can't recreate Fifth Avenue. You can't recreate Bond Street in London. And these are the places where the retailers have to be for their brand credibility.
Why are those prices able to continue rising? I know you mentioned a small tick down, but the overall trend here is higher and higher. Does that speak to the sort of wealth disparity that has arisen where these luxury stores can maintain income and can maintain their client base?
Well, I wouldn't say wealth disparity, but certainly wealth has been increasing, and we've seen new entrants into the market. So the example I used a moment ago was China, which represented about 1% of global luxury spend back in 2000. Now it's over 30%. So there are new entrants into the market, and those entrants are wealthier.
I wonder if you could give us your views on secondary and tertiary markets in the U.S. I mean, Fifth Avenue, you compared it to Bond Street in London, right? But what about Seattle? What about Austin? What about Portland, Oregon?
Well, we're seeing strength in those markets as well. Seattle, Denver actually made our list as two of the top markets in the United States. And those markets have similar dynamics to what you might see in New York, certainly at a lower price point for the rent and the amount of spend. But once you go one ring outside of that to even smaller markets, that's when you might see some weakness. Though I would tell you that overall, retail has done quite well in the United States because the consumer's been strong.
I would think as long as I have a store in New York, in Chicago, in L.A., most of my business is probably going to be online no matter what I'm doing. So I just need those flagship points, right?
Well, I think the only area I might differ with you there is that the amount of online spending for luxury goods is somewhat lower than spending online for other types of goods.
I see that.
The encroachment isn't quite as big, but you're entirely correct on your basic point, which is people are going to Fifth Avenue or Bond Street or markets in Hong Kong for that brand awareness. It's not just to sell goods, it is to make their brand more valuable.
Where are sort of the main areas where then, I mean, obviously there has been some online growth, but how is that sort of playing out in terms of the actual flagship stores versus their online sales?
Well, I would say that the online sales has gone from basically 1% of all luxury sales to close to 7% today. And I would say that the way retailers look at rent, they look at it as a percentage of sales. And it used to be just percentage of sales in the store, but now they have to look at it, is it going to drive online sales as well? So some of those formulas are different.
Got it. All right. Great stuff. Spencer Levy, he's head of research at CBRE Americas. And up next, we're going to show you what you can't miss in the markets.
All right, don't miss this. Coming up tomorrow, GDP third quarter for the U.S. at 8:30 a.m.
I'm very much looking forward to it. Go USA. Can we root for that?
Absolutely.
Is that fair?
That's all for What You Missed. Thanks for watching.
This is